All right, let's jump right in. We're not just talking about taxes today. Think of this more like a forensic investigation. Yeah, a deep dive into a little corner of the tax code that could be quietly costing you, or maybe your parents, thousands of dollars year after year. This is all about defending your wealth. And this idea of logical bleed, it's something that usually happens right out in the open. It's those little, unclaimed costs that are tied to your healthcare. You know, that trip to the pharmacy, the drive to physical therapy, maybe even a flight to see a specialist. Each one seems small, right? But think of it like a tiny leak in a pipe. Over time, all those little drips can drain a ton of value from your portfolio.
Okay, so this is where it gets really interesting. The whole point is right here on the screen. Just look at this massive gap the IRS has created. For 2025, if you drive a single mile for your business, they say it's worth 70 cents. Okay, fair enough. But what if you drive that exact same mile in the exact same car for, essential medical care? Suddenly, the IRS says that mile is only worth 21 cents. That's a nearly 50-cent difference for every single mile. It's wild.
I mean, it seems absurd, doesn't it? So why? Let's dig in and investigate the official reason for this gap and, more importantly, what it's actually doing to your wallet. Because trust me, this isn't some random accident. It is absolutely by design. All right, so first up, we're going to deconstruct the tax code a bit to really get the government's logic here. Because once you understand how they built the system, you can figure out how to make it work for you. So here's how the IRS justifies that huge 49-cent gap. Their logic is that the business rate includes all the fixed costs of owning a car. You know, stuff like insurance, depreciation, the works. But the medical rate, they say that's only for the variable costs, which is basically just gas and oil. Now, I have to ask, does anyone really think your car magically stops depreciating when you're driving it to the hospital? Of course not. And just look at this chart. It lays out the trend in stark detail. This isn't some stable gap we're talking about. It's a chasm, and it's getting wider every single year. It went from 38 cents back in 2019 to a projected 52 cents in 2026. The takeaway here, the system is literally designed to become less and less fair to medical travelers as time goes on. And hey, just think about it for a second. If your car gets, less than 17 miles per gallon and gas is hovering around 350, well, your actual fuel cost per mile is already more than that 21 cents they're giving you. So the standard rate, it's not a reimbursement at all. The source material calls it a containment valve for the government. It's built to limit their revenue loss, not to actually make you whole. Okay, but it's not all doom and gloom, I promise. There is a really powerful, and hugely underutilized opportunity that's hiding in plain sight, right there in the tax code. So let's see how we can use this to start building our case for recovering that wealth. This right here is straight from IRS Publication 502, and you've got to pay attention to the magic words. Seriously, first up, or other person. What does that mean? It means it doesn't have to be a nurse or some licensed pro. It can be a spouse, an adult child, a good friend. Then the second key phrase, unable to travel alone. This is the key that unlocks a ton of value. And the key thing to understand is what unable to travel alone actually means in a legal sense. And you might be surprised. It's a really broad and accessible standard. It does not mean the person has to be bedridden, not at all. There are tax court rulings like the Estate of Baral v. Commissioner that have backed this up. It applies to anyone who can't safely handle the logistics of travel. Think about someone with vision loss who can't read the signs in an airport, or someone with cognitive decline who needs supervision. That's the standard. And this is where you see the real financial firepower of that definition. Look at this. A single patient flies to, say, the Mayo Clinic, and they might deduct around $785. Okay. But if a doctor says it's medically necessary for their spouse to come along, boom, that deduction can jump to over $1,500. You see, the companion's ticket isn't a vacation. In the eyes of the IRS, it's basically a deductible medical supply. Okay, so this all sounds amazing, right? But how do you actually prove it to an IRS auditor if they come knocking? Well, you don't just claim it and hope for the best. No, you build an evidence locker. You get ready for that audit long before it could ever happen. First tool in that evidence locker is what I call a zero-trust medical mileage log. And forget about just scribbling a few notes on a calendar. I'm talking about a real spreadsheet with these 6 essential columns. And you have to be specific. The purpose isn't just doctor's appointment. No, it's chemotherapy appointment or post-op checkup.
This level of detail shuts down any questions an auditor could possibly have before they even ask them.
All right, tool number 2. And honestly, this might be the most critical piece of the whole puzzle. It's the letter of medical necessity, or LOMN for short. This is the single document that makes your companion deduction basically bulletproof.
Now, this is not just some casual note from your doctor. A proper LOMN needs very precise, almost legalistic language. It has to state the specific diagnosis, the functional limitation that diagnosis causes, and then, this is the most important part, it has to prescribe a travel companion, just like a doctor would prescribe medication. This letter is what officially turns a family member from just a travel partner into a deductible medical asset as far as the tax code is concerned.
Okay, so you've got the tools. Now we need to talk about the traps, because the IRS has very specific rules that are designed to deny these kinds of deductions, and you absolutely need to know what they are to avoid them. First up is the lodging cap. The IRS limits your deduction for a hotel to just $50 a night. And get this, that rate hasn't been updated for inflation since 1984. Can you believe that? $50 is almost useless today. But, and this is a big but, it's $50 per person. So if you have that medically necessary companion with you, that cap instantly doubles to $100 a night. Still not a lot, but way better. So the big takeaway here is to avoid these major red flags. Number 1, no medical tourism. If your doctor just says, hey, go to a warmer climate, it'll be good for you, that's not deductible. But if they refer you to a specific specialist in that warmer climate, that is deductible. See the difference? Number 2, don't be lavish or extravagant. Stay at the Holiday Inn, not the Ritz-Carlton. And number 3, just forget about meals. They are almost never deductible as a medical travel expense. Period. All right, let's get to the final piece of this whole investigation. This is the payoff. Let's see how tracking all these small, easy-to-ignore travel costs can suddenly unlock a major, game-changing deduction. This right here, this is the biggest hurdle for most people. It's called the 7.5% AGI threshold. Basically, the IRS says you can only start deducting your medical bills after the total amount exceeds 7.5% of your income. So if you have a $50,000 adjusted gross income, that means the first $3,750 you spend on healthcare gives you exactly zero tax benefit. It's a really high bar to clear. But watch what happens here. This is what we call the tipping point. Let's say your normal copays and premiums for the year add up to $3,000. Well, that's below the threshold, so you get nothing. Bummer. But now, what if you add $1,500 in meticulously documented medical travel, with a companion, of course? Your new total is $4,500. You've just blown past that threshold. And now you can deduct every single dollar above that $3,750 mark. The travel wasn't just another small deduction. It was the key that unlocked the entire medical deduction. And that, right there, is the ultimate payoff. By treating these expenses with this kind of forensic detail, you are actively protecting your assets from that logistical bleed we started with. It's so much more than just saving a few receipts. It's about taking control and becoming the logistics manager for your own financial health. So I'll leave you with this question. You now have the forensic toolkit, right? You've got the zero trust log and the letter of medical necessity. This whole thing isn't just about finding a few extra deductions. It's about executing a wealth recovery protocol. So how much of your own money are you going to reclaim from the tax code this year?